The following is a presentation of TFNN. It is now time for the Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi everyone, Basil Chapman, Tiger Technicians Hour. My pleasure to be here Monday through Friday on market days. And of course, you've heard all the way from 8 o'clock this morning until, actually today's Tuesday, all the way till 6 o'clock, we're going to have programming. So thank you to John and Steve for kicking us off early at 8 o'clock. And straight after me today, you'll have the Options Hour. Just fabulous programming. And what we try to do here at TFNN is to educate. We try to show you the different techniques that we have used successfully for a very long time. And we've gone through the trials and errors, and now we're giving you the benefits. So my service here is the Tiger Technicians Hour. This is the call-in show at 877-927-6648, as well as my opening call. That's my daily service that goes out every morning very early, starting at about, I send to the Tiger, front page of Tiger. You'll be able to go to my opening call with the Chapman Wave methodology. You'll be able to go there from about 6:30, maybe 7 o'clock in the morning. I start sending these charts out. I always send out the very first one is the Dow chart. That's this one here. There's always a little paragraph that I put in, plus at the bottom I update it to give you a whole bunch of information. I show you the patterns. There it is. There's the pattern. There's that arch pattern that I was talking about, a bounce and a failure that we were expecting. One of the reasons why we are remaining short at this particular point. There's another thing that's going on. This is daily, so that if you're studying and you're learning the Chapman Wave methodology, perhaps you have my CD introducing the Chapman Wave methodology right here. This is what it looks like, a CD book. Very comprehensive, 27 chapters, but in fact, it's really simple. The concept is so simple. You go from the lowest, most identifiable low bar, and you merely count each successively higher peak. In fact, I did that yesterday with what I call the naked chart when I subbed for Darrell Martin, who's away, and I did his show yesterday. Won't be able to do it today. Might be able to do it tomorrow. We'll see. But in the meantime, back at the ranch, all you do is you identify the lowest, most obvious low bar. Now here's something else that's very important. I'm going to go through these things step by step because, as far as I'm concerned, identifying the trend is always the most important thing that you can do. Why? Because if you are able to identify a trend, let me see if I've got it here. No, this is not what I want to look at. I think it's 68. Maybe it's 68. Let's go to 68. No. Oh, okay, I'll find it in a minute. I'm just trying to find you on the CD. I should be able to do that. The trend. Let me see. I'll put in trend. So what we like to do is to be able to identify the overall trend, because if you can get the trend, it is so important. Why? Because once you get the trend, you're able to identify whether the tide is going to low tide or to high tide. And all you need to do once you've got that is to say to yourself, okay, I've got the tide. That means if I'm going to trade against the tide, you have to put in very tight stops or buy stops. Why? Because as I like to talk about okay, I'm going to find a little later on. I'm not going to just run through every single page because I should be able to recognize it very quickly. When you identify the larger trend, it means that if you are going to trade against it, you know that you're just playing the bounces or the dips, because if you throw out a piece of driftwood you're at the ocean and the tide is going down, what will happen to that driftwood? No matter what happens, that driftwood is not coming back to shore. It's being pushed away, pushed away, pushed away. If the tide is coming in, no matter what happens, it isn't going out. It is being pushed back in. So the tide essentially helps you. If you are wrong in your direction, you're in trouble. But if you're right in your direction and you go a little early into the wrong trend, you'll be saved, because the bigger picture is going to say, hey, we're washing back to shore. If the tide is coming in, you're fine. Don't worry. You're a little early. And if you're going out, you're a little early, but the tide is going out. So we'll look at that. In the meantime, this ugly candle right here on Thursday, that 300-point decline, that said that the Dow has started a trend in the daily chart that is accelerating into the sell mode. Remember, I don't go sell signal to sell mode very often. Sometimes there's a bar, as there was in the weekly chart, that went on Friday in the weekly chart of the Dow from a sell signal to a sell mode. Here's another thing that's really important. When you're trying to identify from the lowest low bar, you don't need all this stuff around here. I could just take this simple chart and go from this low bar on the E-mini on the 2-minute chart at 8:38 this morning, at 1222.75 in the price of the E-mini September, counting each peak, A, B, C, D. That's where you could have taken profits, or you could have held a little longer. It went to E, to that 200-period moving average resistance, and it really took a dive from the 1228.75 high to the low of 1220, right there, 1220 at 10:06, 6 minutes past 10, after some economic news came out, which might have been a little bit better than expected, but didn't help the market. Now what we're seeing is we've got another peak, A, B, C, D. What's the objective in the Chapman wave methodology? From the lowest low bar, most identifiable low bar, to make it easy. There are other ways of doing it, but this is the easiest way. Just merely count each successively higher peak. When you get to peak D, the fourth highest peak, start to think of taking profits, raise your stop, take off half, or be prepared that there could be a pullback. There doesn't have to be. And as Peek in the Dan says, the trend is your friend. Now look at this. You've got the E-mini stuck in this rectangle formation. And I mentioned to my subscribers to my opening call this morning, I always show this, the daily and the 120-minute chart. I don't give trades on this. That would just really be another service altogether. So I don't do that. I do give parameters, and I say what it's looking like and what should be expected. Now, I said there's a trading range, and it'll take a big effort to go just a little bit above peak C in this rectangle formation, just to go to a D, and then it'll probably decline. Well, we haven't had that kind of strength yet. There are attempts. Little waves are washing up here, trying to move higher. We'll see if they can succeed during the rest of the day. The most important thing is that the volatility index, and then I'll get to the actual numbers in the market, since the Dow is down 55, S&P's down 6.5. But what I wanted to show is that the volatility index is starting the day's young. We don't know, but it's starting to acknowledge that there is internal selling. There's selling pressure. And until it goes underneath 1459 and closes there, so far, we've seen waves of selling come in. Every time there's a rally attempt, the sellers come in and they push both the VIX a little bit higher from the candle that was made earlier with a low of 14.69 and a high of 1680. We're going to watch that real carefully. Now, I do want to mention, just for my subscribers, if anyone's listening, I did send an update on our short position, which I was distracted, got little grandkids here, and for some reason, I was totally distracted, completely forgot. We actually rebought our position yesterday. So that's what you want to use. Don't add two positions to that. If you want to go with the other position that I added this morning, that's fine, because once it's written down, it's written down. There's nothing I can do. So once a day newsletter, unless I say there's going to be an update, and I never said that today. So please, if you've got yesterday's position, don't be adding to it. I don't think you would in any case, but that's what we've got. So now let me just go through the numbers. The Dow is down 42 at 16,527. The S&P is down 4.73 at 1943. You've got the comp index. The comp index now is down 5 at 4,379. You've got gold is down 4 at 1284. It's just stuck in this range. Why? Because look at the dollar. Look how powerful the dollar has been. This is the dollar in leg G/C in the daily chart, leg D in the 120-minute chart, breaking out to new recovery highs, just extended the weekly chart to leg B, and the monthly chart is actually improving even as we speak, and that's really important. Why? Because at 81.61 on the index, you want to see the dollar index really climb and close on the monthly basis above 82.67. That's the high of September of a year ago, September of 2013. And we'll at the same time just grab a quick look at the EUR-USD. This is doing the exact opposite leg, E on the downside, a rally failure. This is the H pattern. And this says that today or tomorrow, at the absolute latest, there has to be a spring back right into the arch formation above 1.33661. The low of the 30th of July. But most importantly, to get the W formation in the MACD, there has to be a very strong bounce, and it needs to go above 1.343 to really show that there's rebounding strength in the euro rather than this terrible weakness. But it is under the 200-period moving average in the weekly. And as I said yesterday or the day before, the monthly chart says the most important support level is going to be this trend line in the monthly chart at 1.320. That's what, if it doesn't hold that, that's a real problem for many reasons. And most importantly, let me just quickly go back to the dollar. If the dollar is in G, and the MACD says there's a chance that it could be in G, but the stochastic is still so powerful that I'm inclined to think that there will be a leg D to the upside. But all I can say is, on a shorter-term basis, 81.25 is the key. 81.25 to 81.08 are the support levels in the dollar, and it's trading right now at 81.61, up very strongly, up 28 cents. And let's just go to bonds, the TLTs, the Lehman 20-year T-bond fund, holding okay, down 40 cents at 113.85, but it's really saying to me that, let me just go to bonds as well. The bonds themselves are down just 10 30 seconds at 137 and 25 30 seconds. I shouldn't say just. I really would have expected that that bonds would have bounced a little bit better and gone above yesterday's high with the market this week. It should have been up above 138.5, and it's not. So I think they just stuck in a trading range with a TYX. The TYX, the yield, the 30-year yield, coming off the bottom, it's going to be very interesting. The other parameters, if the yield takes out, instead of being at 3.32%, it breaks under 3.26%, closes under that, that's a big negative. It'll be going down. Good for bonds, lousy for the yield. If in the next 3 to 5 sessions, 33.373, 33.73 is taken out on the upside, that's stupendous. That is saying to those people who are looking for higher yields and lower bonds, that in fact we've started a move that should take bonds to the 3.489% area. If there's a close at any point into the 3.4 area, that would be the upside target. Right now, I just think it's stuck in a range, but we will see. So I think we've covered a chunk of stuff. I didn't do copper. HGU. Right now, copper is down. This is going to be the thing. If copper breaks under 3.17, be careful. I'll be right back. Basil Chapman, Tiger Technicians Hour. Call in. Love to hear from you.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Investors, Taz Market Research delivers to its subscribers expert commentary on the analysis of 15 different markets each day. Get this invaluable and timely information through the daily market research videos Taz Market Research produces each day before 9 a.m. The video analysis will include reports on currencies, interest rates, indices, metals, energies, grains, and more. You'll be able to gauge where high profitability setups are in each of the markets. Receive a free 2-week trial subscription to Taz Market Research videos on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing. Basil takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Couple of questions I have, I'm going to answer them right now. TMO, which is one of my, this is one of my favorite stocks never to own. Thermo Fisher Scientific. Could have bought it years ago and just held it and done nothing else because I've loved it. It's just a great company for some reason. Look at this chart in the monthly. It never gave you a clear chance to get in on a pullback because it didn't have the pullback. It just, in fact, from June of 2012. This is a monthly chart. June, I'm going to say it again. This is June of 2012, over 2 years ago. There has only been one peak, a tiny little peak C at 89.50 and then 89. So it's a 50-cent high bar. Next bar was just a little bit lower. And then it goes up. So it goes up again for almost a year, And then it goes up to the high of March of this year at 127.63, and now it's pulled back, had a cup formation that went to 127.21, and it's kind of digesting those gains, and it did a 200% expansion in the Chapman wave using the Fibonacci expansion. The 9-period moving average, since it broke out back in that time, that was August of 2012, it hasn't once even come close to the 9-period exponential moving average. Now that's at 115. I have a sign that says, the question is, what about it? And my answer is, I would not be buying it right now. Yes, it could pop 5%. I wouldn't dismiss that. So it's a nice move. But the reality is that if it takes out 118 on a monthly basis, it says be careful, because it's going to then it's probably going to test the low of July of 2014 of 116. If it takes that out, it'll do a full 100% retracement to the 112.02 low of May of this year. So I'm inclined to say it's in the category of great stocks that just needs a timeout, but a timeout based on the MACD in the monthly chart says while there could be a 5% pullback, there could be a 5% up move, I don't have a bias to say to you that it's worth buying right now. At the same time, if you were to short, I would only put one short on here and another short at 121.18, another short at 122.80, and that would have a 1 point buy stop on that. But my choice of direction now says that the tide has turned, and if the MACD deflects this week to the downside with a stochastic only at 76% in the weekly chart, that MACD's fast-moving average is going to touch the red one, and that's a good 4 points, 5 points to the downside. So my bias is to say I would not buy it. I would be contemplating shorting it only because it's a great stock that is overbought and it needs to digest, or you could just sit there and say I'm going to wait. I'm going to see how the 116 to 112 area holds in the next 4 to 6 weeks. Just simple. So that's that. Next thing was the XLF. Just the question on the XLF was, why would high interest rates benefit the banks? And the answer is, I'll make it as succinct as possible. I have no clue. That's just what I read, and that's what I hear, and that seems to be what happens. My suspicion, I mean, you really need to be in banking to know this because these are the insider stories. My suspicion is that if they can lock in very low yields and then start to see the rates start to increase, it takes a long time before they actually give back to the investors any part of those gains. It's like when you've got gas prices going up, you'll see the ladder outside within a split second where they raise the price, and when it comes down, they just can't tell what it is. They just can't find. They can't find the ladder. It just, it's a tough thing. You put the ladder away, just can't find it. So it takes a long time for prices to come down at the pump. Very quick to go up. But basically, I mean, the whole concept is that banks lock in lower rates and they charge you higher rates, and that's how they make their money. I think that's the way it is. It's got a couple of notes in the den. Let's see. Banks borrow on short rates, which are very low, and lends at higher rates. Yep, that's the way it is. Margins, just margins. They're playing the margin game. It's real simple. Because actually, you think they're playing the margin game. They're making money on those fees. A fee for everything. They've taken the airline industry as a beautiful example of how to squeeze. And squeeze they are. So let me do this now. There was another question. I'll get to the other question in a little while. Just one quick thing. Chris wanted to know, and I'll do it right now, about the Chapman Wave Trin Index. Let me put it up here, and I hope by within 3 or 4 minutes I'm going to still remember where I was. Someone will remind me. I'm going to talk about the Trin gauge. I won't give the numbers, but I will give you what I was looking at for that double helix, that double move yesterday. I'll be right back.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Andy Heck's powerful weekly newsletter, the Technomental Commodity Report, has delivered multiple triple-digit winning trades in recent months. And right now's the perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $59 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Who says you can't take it with you? TFNN says you can. With your mobile device and TFNN's live radio streams, TFNN has put it all in the palm of your hands. No special apps to download. No subscription fees for live radio or Tiger TV streams. We say you can.
Now let's go over to the dollar, because the dollar is going to be the generator. It is the generator of basically higher dollar, lower market. And what the dollar has done, and this whole uptrend, folks, has just gone sideways. The way it works, folks, is this.
We say you can. The Tiger Financial News Network. Smart investors and professional traders know you can. TFNN.com. Educating investors. This segment is brought to you by Harmony Gold. For more information, just click the Harmony Gold banner on the front page of TFNN.com.
Hi, folks, we're back, and I just wanted to show this chart right here. It's out of the five little sectors that I have for my overview and the market today section, where I discuss what to look for, why we're looking at it, and what the importance is. I also have something that is Richard Arm's Trin Index. It's right there. That's his index, but I use it in a particular way that turns it into a tool, into a technical tool, and a technical tool that has. I just don't want to waste time counting it, because it's been so accurate. It's missed a couple of times. It's got an accuracy rate up in the 90% rate. Actually, if I was to be really strict, it's probably about 94-96% accuracy. And what it did the other day is it gave a high reading and a low reading, and both of those, one of them would indicate that there should be, within one day, the very next day, there should be a rally in the E-mini futures of 7 to 9 points that should translate into the index, the cash indexes, but it does start there and it does filter, which is exactly what happened. Another index that occurred on the same day, so unusual. I mean, I could go back wonder if I should go back now and see it. I could go back, and no, I can't find any. I just don't recall. I do remember once that there was one, either a day later but I just don't remember on the same day. Yep, there it is. No, it's a day later. Let me just double check. No, it's a day later. I just don't remember on the same day getting a signal that says you're going to bounce immediately, that is within a day, and another signal that says you might pull back quite sharply, but there's going to be a 7 to 9 point reflex rally intraday before pulling back in the cash as the E-mini futures rolls over into the opening trades on the cash at 9:30 in the morning Eastern time, and there should be a translation into that. Well, we saw that yesterday, a combined effort from the Thursday indication of Friday. It happened Friday intraday. It wasn't that obvious, but it certainly happened, and then it happened beautifully like a double kicker yesterday. And the S&P was up about 13, Dow was up about 75. So I use it on the S&P, actually, it's E-minis. So I just wanted to explain that. And the next thing I had a question was Goldman Sachs. Well, first of all, there was one that I was looking at in the demo. I was looking at Thermo Fisher, we've done that. So the next thing is Goldman Sachs. Goldman Sachs trading right now, it's 170.79, down 90 cents. And you know what's really interesting about this? If you look at the chart of the monthly, it's exactly the same as, it's not exactly the same, but the last rally has the same cup formation to the double top as Thermo Fisher and so many other indexes. And this says that unless Goldman Sachs, which is trading at 170, can spike 12 points to 182 to break out and then hold above that, this is just going to look like a double top. And we're going to look at that's the monthly leg, a peak E, trying to retest. Stochastic and MACD are not that great that it finds that kind of strength. It's a peak C, which is what I call a great peak C. It's under the last peak G in the weekly chart. And the MACD and stochastic are good, but it's not able to rally back towards the 177.48, most recent high, week of the 1st of August last week. And the MACD is good, stochastic's at 83%, but if it doesn't find strength, next time these technicals start to deteriorate, the price will also deteriorate. And what we've got here is a single, this is very unusual. This is an alternate count. I should have put that in. Let me remove this right now and put it as an, so the question was, I'll go to the question in a second. Let me just finish this. The question was, so this is an F/A and a G/B. And that's all we need to know, because everything about it right now says there's a really good chance that it's in a G rather than in a B, because the MACD and stochastic are turning down sharply. So we're watching Goldman Sachs, because if it takes out 168, if it closes under 168, it says, be careful, I'm making the arch formation. I'm going to test the 164, 200-period exponential moving average. If it closes under 173, that's good action, not great, but good. It says, yeah, I can bounce a little bit more, but just treat it as a bounce. So that was Goldman Sachs. IBM was a question. What is IBM, the wave count? IBM made a peak E, and the last move up to 196.40. It's testing the 200-period exponential moving average at 188.12. That's where it is right now. And the weekly chart made a V-shaped formation that it's failing. If IBM breaks under 185, 3 points lower, closes under that, that's very negative. If it closes above 192 this Friday, I'd say, whoa, that's quite good. Not great action, but it's good. It's holding up okay. The monthly chart says, be careful. IBM is losing a lot of upside momentum at this particular point. Next question was the euro. I did the euro, but I'll do it in a little bit more detail. This person wants it in a little bit more detail. Okay, the 120-minute chart is the clue here. The 120-minute chart failed to make a D, and that's usually very negative. It went to an A, and then it went to a B minus. That usually says, wow, B minus is you're going to retrace all the way back to retest the lows. And in this case, that's the low of 11 o'clock on the 30th at 1.33661. It's trading now at 1.33676, so it's above that, but it did spike low. Remember the arch formation. This is a type of an arch formation. Look, there it is. Semicircle up. Got it down on the right there. And now what we're looking at is that this low has been tested And the bar that takes out the low is the very bar, if not that bar, but the very next bar, has to bounce and close above that. So far, it's done it. It says that the euro is ready for a little bit of a bounce. The technicals are still very poor, but I'm going to, if you don't mind, questioner, I'm going to put this together with the dollar, which is in leg D, and there is a chance with a MACD like this might be just making a G. That's what happens very often. It did it once before. The last peak was a peak G back on the 5th of June in the index. And if you look at the DXU, that's saying DE. This could be F. So I'm looking at this and I'm saying it's such a strong candle that there might be a little bit more residual strength, but the dollar index definitely is getting ready for some kind of a little digestive period. And the futures is at 81,650. I suspect 81.31 to 81.15 will be the first support. But if it does slide, you could see a slide into the low 81s. And then try for that cup formation. So I don't see anything negative yet on the dollar. And so let's go back to the euro so I can at least give you the parameters to look for. In the euro, if you don't mind, I'm going to go to the weekly chart. The low bar of the week of the 8th of November at 1.3297, that's the one. If it takes that out, then the very next support, not only has the 200-period exponential moving average and the weekly chart become a repellent, but it means that there's a good chance that it'll go somewhere. It doesn't have to go right to the low of 1.310, the low of the 6th of September, the week of the 6th of September of 2013. But it does say that this candle right here, right there, the candle of the week of the 13th, between 1.332 and 1.316, that's the candle. That's going to be really important support to hold. What you want to see, if let's just say you're thinking of a counter trend bounce in the euro, well, then what I'd be doing is I'd be looking at the daily and saying, okay, this is the last H pattern, and it's a big failure pattern. These often turn out to be, I wonder if I can find it in my CD. Let me see if I can get it right here. These can turn into larger H to M, lowercase m patterns. So what I would do then is I'd be looking at, let me just go to that. So that's going to be chapter 17. So here we go, chapter 17, chapter 17 right there. And we want, look, that scallop formation, that H, lowercase h, continues down. At a certain point, it gets larger, or it does this, and this is going to be very important, or it does that. It goes into a lowercase m formation. So that's what I'd be looking at right here. If on a weekly basis, on a daily basis, if by the end of the day the euro, EUR/USD is able to rally just a tad higher and close somewhere at 1.338, then you might start to see that the euro is trying to form some kind of a base with tremendous support between 1.335 and 1.332. That's going to be very important. The more it can trade in this above the left side low of 1.33661, the stronger it is for not breaking down, but not necessarily stronger it is for breaking to the upside. We'll have to wait to see what the dollar does. So I hope that that helps you for the euro-dollar currency pair. And then I said I was going to do what? I had it all written down. Goldman Sachs, Dow, did all that. Let me just turn around. Count on IBM, count Goldman Sachs. Did I finish Goldman Sachs? Yeah, Goldman Sachs I did finish. Yes. So let's go back to the XLF because it's part of the Goldman Sachs chart pattern that we're looking at. Goldman Sachs is an important component of the XLF. The whole thing about the XLF, the S&P Financial Select Spider Fund, is that the 9-period moving average, which it hasn't broken, it's been so close to, and it just hasn't broken it yet at 21.90, and right now it's at 22.31, the XLF. Every indication, yes, is that there should be a mild pullback in the financials. But if there's a greater pullback and the 20 level is taken out anytime in August, be careful, because it's going to directly impact many of the other areas. And that'll be a peak D, a serious peak D in the weekly chart. And then you can say, okay, if that's the case, and actually the level that I'm really watching is 21.19. A close under 21.19 will be very negative. So then I think I've covered a chunk of stuff. Oh, I know what I want you to do. I want to go back to this chart here, not this one, but this one right here. Look, yesterday I did Daryl's show. And I did a 10-minute chart. I called it the naked chart. Why? Because there really wasn't a single technical aspect to it other than the Chapman wave methodology. And what I'd said is you try to identify the lowest, most obvious low bar and merely count each successively higher peak. So what happened was we went to, did I do this? A, B, C, D, E, F. Right, so you go. I'm just going to go from here because that's what's in front of me, 19, 10, 50, 19, 50, 19, 10, 50, 19, 10, 50. Okay, so this is from the lowest identifiable low bar. You look for at least a peak D, but it could go 5 and 6 higher peaks above that. So look what happens in this particular instance. It goes A, B, C, and then it goes to a D, and then it has its sharpest pullback. And then it has a sudden spike to the upside that goes E and F. F is where you got to be really careful because that's where you can get a very powerful move to the downside. And lo and behold, that's exactly what transpires. Goes F, plunges and goes peak A, B, and then it fails at a C. And this is really interesting. It doesn't often fail at C, but it does after an initial takeoff bar that is very sharp, and then if it continues higher. So you go A, B, this is the E-mini 10-minute chart. And then it goes C, and it goes C minus because it fails. Then it starts a brand new move, and this one goes A to B to C, a whole bunch of C's, and then it breaks out and it goes D to E, and it pulls back and starts a brand new A to B to C to D and pulls back. And then this is where we were. And what I'd said is there's a pattern in the Chapman wave methodology that I call the falling axe. That's right here. That is chapter 24. And this is very important. Why? Because if you can identify these two important trend lines, see the trend line with lower highs and then much lower lows, that in fact can be a powerful move to the upside, a one-to-one. And that's what I was talking about yesterday. And I said if it breaks out above that, we could get a one-to-one to the upside. And what I had drawn in is at about 1932 on the E-minis, that would be the projection. Well, the show finished. We were somewhere around here, and look what happened. It went not only to D, it went to an E. It went right to the 1932 level to 1937.50, and then it pulled back. And now it's in this H pattern that goes to an M pattern, then fails, and a brand new peak, A, B, C, D, 4 peaks to the upside, plop, it comes down, it makes that H pattern, and now what we've got is a choppy range, very wide choppy range, choppy and wide only in the sense of the parameters of the 10-minute chart, that is. So I just wanted to show that just to follow through on what we were looking at yesterday. It was at the 1 o'clock hour that I did Daryl's show. Now let me just make this a little bit smaller. There it is, out the way. And now let me go through a couple of other things. I had a question, a kind of a generic question, just to say, what made you so bearish? How did you turn so bearish, and why? Well, let me just go back to the Dow chart. First of all, I'm going to do this with the time frames of the daily, the weekly. Let me get rid of this one here. 120-minute chart, just everything so that you can see what I look at. I don't like to do things in just one medium. I like to do it in multi-mediums. In other words, this is multi-time frames. And I'll explain what I was looking at, why I was looking at it, why I was very worried and still very worried about my weekly and monthly charts. I have to tell you, this is making me kind of nervous. That's the reason why we are short in the opening call. I'll be right back.
you take a hands-on approach to managing your investments. And whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com. Eastern legend tells of a fair maiden who was offered a rare gift by the king of the land, a bag of pearls. The king promised that she could keep the largest, most perfect pearl she could find with these 3 conditions. 1, choose only 1 pearl. 2, remove 1 pearl at a time, accept or reject it. And 3, if rejected, it would be lost forever. She began by looking at the pearls, passing on many special treasures. She delved deeper into the bag, and soon the pearls were replaced with pebbles. Sadly, she went home empty-handed. Folks, replace pearls with time, because we cannot go back even 2 seconds. We live in the eternal moment of now. So when now are you going to take advantage of my offer to you, a subscription to my daily investment newsletter service, Mastering Probability, where you can experience the most incredible pearls for trading and investing, the Rhodes Momentum Indicator and Strategy. The offer? It gets better. A 30-day money-back guarantee. Don't go home empty-handed. Mastering Probability. Available on the homepage of TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This segment is brought to you by BackTech Environmental. For more information, just click the BackTech banner on the front page of TFNN.com.
I've asked a couple of questions I'll get to, but let me just go through this. We were somewhere over here, and I said that the technicals are starting to fail in the Dow. It's made a peak D. It's rallied. It should have had enough strength to be able to take out the high of 17,151. And for some reason, 17,151. And for some reason, it just couldn't do that. And as it was doing that, the stochastic started to turn down, the MACD turned down a little bit. And then you got that plunge back on the 25th of July, which tested the uptrend, the up channel support, and it broke it. More importantly, as it was happening, what I was looking at is that the weekly chart was showing signs of an apex coming to a head. That's a rising wedge formation. The 9-period moving average was being touched for the first time many times during the last few weeks. And because of it, it was saying that there was a slowing in the upside momentum. Not only that, I had Chapman wave stalk leg formation, which gives you the leg, the body, and then the neck formation, and then it makes the head. And that's where I got nervous, saying, uh-oh, if that's the head, the stalk should take you, the beak, that's what's called the beak should take you at least to the under the 16,631 high of the 4th of the week of the 4th of April. Well, we're under that right now, and you're breaking up channel support. A whole bunch of things are going on, and the MACD and stochastic are looking very weak. Now I say to myself, oh no, we're in leg E. There might have been a recycle. This could be, in fact, some kind of a peak D, and this is a brand new leg E/E/A. At this point, I'm not even prepared to mess around like that. I'm looking at this, and I say, a close below 16,000, let me tell you exactly what the number is. A close below 16,350. I'm going to give it some room. A close on the monthly basis below 16,300 in the monthly chart will be the first close under the 9-period exponential moving average, close that is, since that one bar back in May of 2012 and since the October of 2011 breakout above that black line. Look how beautiful this technique is, the 9-period exponential moving average. And then what did you do? You went right into, not the upper, but the lower. This is, I don't know if I've got room right now. Look, you see these 3 lines? This is the inside track with an extra line attached to it. And it went right to the line, then above it, and so far you've not crossed above it, and this is the second month since it hit that, and this means be careful. So I have to be very cautious here, and that's the reason why our bias now is towards the short side. So I hope I covered that in many aspects, both technical in the Chapman wave methodology, as well as looking at it just from a 120-minute chart to the daily, to the weekly, and we don't know what the monthly is. This is the second or third trading day of the month, and yet it is very important that the high was made the month before, and you start off the next month with a much lower high bar. It makes it way more difficult to achieve. So this is what I'm looking at. And on a quarterly basis, I'm told the 9 EMAs are 17,003. No, wait, I can't read that. That's not the correct. Oh, the S&P, 1732. And the S&P right now is down 9. So what we've got is a weak market. You remember what I said just a long time ago? I said we need to see the short-term, the VIX index start to make higher highs and higher lows and start to make a higher base. At the same time, all news, whether it's good or bad, is treated badly. By the end of the day, you close towards the lows of the day. And then there are those sudden spikes at the upside that completely fail, and that's the characteristic of a change in trend to the bear phase. But this is still just a sell signal in the weekly chart, and we're going to watch this real closely. So, folks, thanks for being here. I'll be back. I believe I'll be back later on with Tom. But check out my opening call. It's my daily service, and I'll be back tomorrow. And have a great rest of the day. Stay tuned for the Options Hour.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
This is TFNN.